Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In this video, I'm going to share with you guys 5 companies that are very high quality companies that have all hit their 52-week lows. And when a great business goes on sale, that's when long-term investors like us start paying attention. Each of one of these companies have a strong cash flow, durable moat, and is also trading at prices we haven't seen for quite some time. Before we start the video, and I'm gonna, before I start talking about these companies, this is another company that I want to talk about. So I just want to mention this company just very briefly because I know a lot of brothers and sisters are interested, and some of us own this company as well in their portfolios and so on. Is the one that used to be in my portfolio as well, and that company is Kimberly-Clark. Kimberly-Clark recently have acquired, well, potentially going to acquire a company called Kenvue. Kenvue is a spin-off from J&J. They paying, $48.7 billion. Kimberly-Clark itself, the market cap for this company is actually basically smaller. So this company is actually bigger. Kenvue is actually bigger than Kimberly right now, because if you look at this $34 billion and this one $48.7 billion, so they're buying a company that's slightly bigger than them. Now I want to talk about just couple of main things, couple of reasons why I actually would not be rushing to buy this company or add to the portfolio anytime soon. And that one, it's the deal itself is basically deemed to be very expensive. So it is quite expensive for Kimberly-Clark to actually buy this company right now as we speak. The second thing is this part here, this litigation that's going on, the Tylenol litigation that has come out recently, and that's still ongoing. For that reason, I don't want to touch any more companies that have got some sort of a legal situation going on. I would have held on to J&J if I wanted that. I've sold J&J for that reason. I sold 3M for that reason. So it is when, and I watched, if you haven't seen it, there's a video on YouTube. If you can go and just, go on YouTube and just type Kimberly-Clark stock. And I think the first one is the interview by Kramer with the CEO. Kramer likes basically stock, but he talks to him about a lot of things, including the Tylenol litigation and everything else, which came up. Basically, they admitted this litigation actually started while the company was still basically negotiating with Kenvue to buy the company. So I don't think they could basically pull away from that situation, and that's probably one of the reasons why they still had to go ahead and buy it. Now the dividend is great, it's a great company, but the one thing that also I found out is that now Simply Safe Dividend, which is what company that I've been using for quite some time, have now downgraded basically on the 4th of November from very safe to safe right now. And the reasons they've laid out is they've talked about the fact that company is buying this company. The two companies combined would have a lot of products and so on. The fact that Kenvue has struggled to grow earnings since 2023, since they've been separated from J&J. So it was a struggling company with the litigation and so on going on. So I don't understand why Kimberly-Clark felt like they needed to pay that premium for this company. And there you go. So considering that backdrop, so if you read this here, meanwhile, more shoppers and chooses lower cost private labels brands. So a lot of household goods are now basically, people are just going to the Asda brand, if instead of buying product that Kimberly-Clark and other companies own, because it is cheaper, right? So based on all of that, they've said market was surprised to basically buy the acquisition news, sending Kimberly-Clark basically about 15% down. Like many other investors, they said they were quite surprised. Management is pitching that the fact that it will unlock faster growth and so on. So the bit that I want to talk about, in fact, is the dividend side of things and the debt levels, because to buy this type of business, you're not really buying for the growth, if you like. Okay, so if in fact we can check KMB, we can check the growth side of things. So in terms of performance over the last whatever years against the S&P 500, 5%. Against the S&P 500 of 10%. So the growth of that dividend has been about 6%. So it's sort of a dividend has been in line with basically the S&P 500, if not even lower, and the growth side of it is not there. So for that reason, you're not buying the company for the growth, you're buying for the dividends, and the dividends is now basically a risk in a way. So a payout ratio will land around about 70 to 75%, which is not far from recent levels. Then you top of that, you've got the debt levels, 3 times the debt level. It's not great. It's not something you want to get into right now. I think things can change. I hope that the deal goes well for this company and the litigation goes away and the company does well. Then maybe I'll look into it. But right now, because there's so much ambiguity going on, there's a lot of risk involved with this company, and everyone that has come out since then have said hold, and that's where it is right now. Even if you click this, you will see it's about 23% upside from $128 per share is where they think the price should be. Arbitrary side of things, maybe I would have done that, but I would not actually want to buy any of the companies. Basically, Kimberly-Clark, I will probably buy Kenvue for the arbitrary side of things, but I wouldn't do that either because that's quite risky as well. So that's all I wanted to say about the company, because I know some of the brothers have asked me in the community and said, what do you think? But let's get started with the first company we're going to talk about. And again, I'd rather own this one because there's no litigation, alhamdulillah, anything like that. It's flat right now, is one of the most reliable dividend growth stocks in the world. The company behind it, Gillette and Pampers and Tide and Head and Shoulders and a million other products. It's been around over 180 years and so on. So it's a great company right now. When it comes to that dividend, you get almost a 3%, less than about 60% payout ratio. In fact, I'm going to double check that because I want to see if that is a 60% or slightly. There you go, 60%. Okay. And then you got latest increase of 5%, the 5-year growth rate of 6%, which is quite nice. 69 years of increase in that dividend. You got $4.23 over every share of this company you own. 99% safety, and they're not going to downgrade anytime too soon because they have excellent free cash flow of $14 billion. So this is a very well run business. If you look at the profitability, return on equity, return on invested capital, and top of that, you just getting that 3%, and on top of that 3 growth side of it, and basically you get that 3% over the last whatever years. So if I now go back here and show you against the S&P 500 how the stock performs, so the performance side of things, if we just focus on that, okay, about that 7%, but that growth was 7% in terms of dividend side of things as well as there. So it's done better than the other one, and is almost undervalued at this point in time. If we look at the forecast moving forward, if we're using that basically 15 PE, it never works anyway. But if we use the normal multiple, which is what Mr. Market likes to trade this company, which is that 24, you'll be making about 3,700 on top of the 10,000 that you invested right now. So that's the first company, and I'd rather own this one. I'd rather just put all the money that I would have put into Kimberly-Clark or Kenvue, whatever. I would rather buy on this one because I know I can sleep well at night and don't have to worry about it. The next one that we're going to look at today is Air Product and Chemicals. This is probably one of the best companies out there when it comes to material side of things. It produces industrial gases used in energy, healthcare, manufacturing, and so on. The stock has fallen sharply over the last few weeks, if you know. But then since they reported, it's gone back up. Right now it's about 24% upside from where we are, expected to grow nicely. The only issue I have with this company is this part here, the free cash flow. And the latest in the management, the CEO is quite new, so they are working on making the company a bit more efficient. Now, profit margin, return on equity, return on invested capital, I'm not sure why it's all in the negative. In fact, let's just go here and check this out. Because that data, APD, I always get these two companies wrong. APD is the one that we're after, not APD. APD is the one that we're after, not ADP. So payout ratio, the latest increase was good. 42 years of increase in that. $7 is what you will get for this company. Now, the bit that we're interested is this here. Earnings per share is growing ahead in the right direction. Shares outstanding is stagnated for the last 5 years or so. They haven't bought it back or anything like that, and I like that because they don't have the free cash flow to buy it anyway, so just left alone. And total sales have gone up 2021, 2022, then now it's sort of stagnated for the last 2 years. And return on equity, yes, we are in the negative. That's interesting. Return investor capital, we are on 6%, so that information was wrong. But return on equity is actually in the negative. I'm gonna check what is going on with that, because Let's go to financials. Let's go to the bit I'm interested is I just want to make sure that in terms of liability and assets it's balanced. That I want to check that out first. So total current assets of $5.8 billion, which is fine. Okay. Against total current liabilities 4.2. So it covers. So the current assets cover current liabilities. The total assets $41 billion. Total liabilities, where is that? 23%. So they've got more liabilities and so on. So so there's nothing huge to worry about here, but it's that free cash flow that really genuinely worries me the most about this company. And the return on invested capital we've seen is already in the positive. Profit margin is fine. If we go back here, okay, operating, what was the operating margins for this one here? Operating margin of about 20%. Free cash flow margin is where the issue is. That's what I always had problems with. If we go on here and have a look, the company in terms of growth side of things, performance over the last whatever years against the S&P 500 is almost in line with that, but the dividend growth is actually way better. And if we look at the forecast moving forward, again, you will lose about 3% of your money if you will look at that 15 PE. If we look at Mr. Market's multiples, which is 25 PE, you would be making about 5,500 if you bought the stock right now. Right, the third company we're going to talk about today is Pool Corporation. This one is the largest wholesale basically distributor of swimming pool supplies. They have a sort of a niche market, if you like. It benefits massively from the pandemic. So at the time of the pandemic, people were staying at home, buying all sorts of things and doing up their houses nicely. The price went up a lot at that point, $9 billion right now. They have a decent dividend. They've been increasing that for 14 years, if you like. 69% safety, which is quite nice. Profitability, return on equity, return on invested capital side of things is okay. Free cash flow is decent for a company of this size. You know, EPS expected to grow, revenue is expected to grow, and Morningstar saying it's almost a 40% up from where we are right now. If we're on fast graph and have a look at it and compare it with the S&P 500 historical side of things, as you can see here, 11%, which is quite nice, and that dividend actually beats the S&P 500. And if we look at the forecast moving forward, that 15 PE is not working. If we use that normal PE, we can see that basically if you bought this stock right now, you'll make about 7,000 on top of the money. So $17,481 per share is what you would have. The next one that we're looking at today is Adobe. Adobe is the one that we've talked about so many times. I don't need to say anything else other than the fact that it's still undervalued by 71%. If we go on here, ADPBE, wait. All right, let's have a look. Performance side of things against the S&P 500 over the last whatever years, it has beaten. It doesn't have any dividends at all. Forecast, okay, as normal estimates. Even if we use the normal estimates right now and you bought the stock, you will make it about $2,000 by 2027. So you will be up about 20%. Now, if we use the normal multiple, so that was, if we go back here, by the way, that was 15 PE. If we use the normal multiple, this is how cheap this company is right now. Is your 10,000 will become 30,632 US dollars if everything works out. But that 38 PE might be a bit too much, in fact. So you might want to say, you know what, maybe let's go down to about 22 PE, for example. So what will that give me? That will give you 18,379. So about 84, or total annualized rate of return of 34%. So wherever you look, the company is still cheap. I don't care what people say about AI and everything else. The next one is Zoetis. Zoetis is a spin-off from Pfizer a while ago. Is the animal health care company. It's been around for quite some time now. And right now, as you can see, is about 42%, has a 42% upside from where we are. They have a dividends that they've been paying for quite some time now. 11 years of increasing that dividend, 74% safety, profit margin, return on equity, return on invested capital, really, really good. So far it looks like a solid business. Then when you look at the growth, again, $2.2 billion of free cash flow right now. EPS expected to grow about 7%, revenue about 5%. And looking at fast graph, if we check the performance against the S&P 500 over the last whatever years, 11%, 12, almost 12% against the S&P 500 of 13%. But again, the remember the time horizon has now been reduced from, so we're looking at from 2013 to basically around 2013, 2012, and up until now. So that's why this has now changed. Again, dividend side of it has beaten the S&P 500, which is quite nice. Forecast moving forward, if we are looking at that 8p earnings per share, so on, if you bought the stock right now, you'll be losing about 1%. But if you use the normal multiple, which is that 36, which is quite high in my opinion, you would be doubling your money. So your 10,000 will become $23,372, which is quite nice to see. If that, even if that doesn't happen, but say for example you think the stock should be around here, okay, that 20 what is that, 23 whatever PE, if you like, then you'll still be making about almost, you know, $4,200 on your money by the time we get to December 31st of December 2027. So all of these companies are undervalued at this point in time. They all hit that 50 to 52 week lows, and as you can see, they're all Sharia compliant, so nothing to worry about that side of things. So yeah, that's what I wanted to share with you guys. There are opportunities out there despite what the market is doing right now in extreme fear, so people could be selling in the next few weeks. You might even get an opportunity to buy some of these high quality businesses even further. So let's see what happens, inshallah. Like I've always said to you guys, I'm just going to hold on to the companies I own. I own these two, so I'm going to quickly show you, and in this portfolio anyway, the two companies that we just talked about, Procter & Gamble, I think is in the red, recently gone in there. There we go, that's it. I'm in the red now by just a bit, so $144 per share is basically my price for this one. And then Air Product and Chemicals is gone up a little bit last couple of days, and this one I'm up about 3% to $257 per share is my average. There you have it. If you haven't joined us at the Patreon account and you haven't liked the video, please do so. It makes a huge difference. Have a wonderful day. Assalamu Alaikum.